that is quite a tradable strategy. Now let's refine this a little bit more. Once again, our setup is yesterday being an inside day. Open greater than yesterday's close. However, we're only going to take this trade if the inside bar is in the direction of our trade. So consequently, we're only going to go long if yesterday's inside bar was a bullish bar, and we're only going to go short if yesterday's inside day was bearish. So let's see how we did here. Well, here we go. We've got fewer trades over the 5.5-year look-back period. But, you know, it's still very interesting to note that our win-loss ratio still stays rather consistent. And when we compare these two strategies together, we see that the win-loss ratio remains quite consistent. Now let's just zoom back out so we can see the S&P 500 for the whole period that we've been backtesting. I'm just backtested inside day number two strategy here for you, and really just to illustrate how smooth this equity curve is, which would indicate to me that this is an eminently tradable system. The interesting thing is that even in periods where we've had a rising market, we can still make money on contra-trend trades. Obviously, the better trades are in the direction of the trend, but that's kind of a typical situation anyway. And we've seen these stats before. Once again, a win-loss ratio of around about 2 to 1. Okay, now one thing I have to point out here with this strategy, or indeed any other strategy of this type, we're looking for a situation where the probability of a winning trade is in our favor. Now, this does not mean that we're definitely going to win. It's just we've got a probability of winning. And if you look down here, you will see that if we trade strategy 2 or strategy 2A, we've got to be able to tolerate at least really 3 consecutive losses. And it's very tempting, you see, when you're trading these strategies, that you take a loss, you take another loss, you take another loss, and then you give up because you think the strategy's a dud. And Sod's Law really decides that you'll be giving up just at the beginning of what could be a run of 11 consecutive wins. Okay, now we're going to move on to outside days, which are really the converse, if you like, of inside days. Now, the definition of an outside day is where the high of yesterday is higher than the high of the day before it, and the low of yesterday is lower than the low of the day before. And this is, in candlestick terms, this is known as an engulfing pattern. And in this particular case, it's a bullish engulfing pattern because we have a down day the day before and a bullish day, an up day, the day afterwards. Now, this is an aside, but outside days are particularly powerful when they come at the end of a trend, especially if they occur on a support or a resistance line. Now, if you look at this outside down here, you can see how we've had a run of down days. This, funnily enough, is actually an outside day as well, but it hasn't broken the trend. But this bar, on the other hand, not only is it an outside day, it's engulfing the bar for the day before, but it's also a very strong bullish day, a very strong reversal bar here. And you can see that afterwards, the market just took off again. However, we're not really concerned about what's going to happen a few days later. We're specifically looking here at just intraday trading strategies. Now, let's look at our first strategy for trading the outside day. This time, our setup must be that yesterday was an outside day. And remember, our definition of an outside day is that the high is going to be higher than the day before, and the low is going to be lower than the low of the day before. Our trade signal: if tomorrow's open is greater than yesterday's high, we're going to buy the open. And if today's open is lower than yesterday's low, we're going to sell the open or go short. In each case, we're going to exit the trade on the close. Now let's look at what this setup looks like in action. Here's our first outside day rather, and you can see that we never actually got a trade setup here, because although we've got an outside day, we're only going to take the trade if the open of this bar was of this bar here was either above the high or underneath the low. And you can see here the open is here, so there's no trade setup here. Over here, we've got another outside day. So when we see that, we actually put our orders in the market for tomorrow, and we say, if the market opens above the high of this bar, I want to go long the market. And if the market opens below the low of this bar, I would go short the market or sell the market. Now in this particular case, it's a good trade because we've opened above the high of this bar, it's an up day, and we've closed ourselves out of the trade here. That's good. But as I mentioned when we were discussing inside bars, unfortunately, life's not always quite as nice as that. So let's look at trading the outside days on the S&P 500 cash index. Okay, the period we're going to look at here is, well, more or less 4 and a bit years of the S&P. And I've highlighted the outside days for you with these vertical grey lines. Okay, going back to our first outside day strategy. Setup, yesterday has got to be an outside day. We're looking for today's open to be greater than yesterday's high. If it is, we're going to buy the market. If today's open is lower than yesterday's low, we're going to sell the market. Let's see how we did. Okay, well, surprisingly few trades. And in fact, over this whole period of time, we've only taken 10 trades, 8 of which were winners, and 2 were losers, which is really quite a remarkable win-loss ratio. And as you can see, it's a very smooth upward equity curve. Now let's modify our trade criteria. Once again, we're looking for yesterday to be an outside day. We're looking for today's open to be greater than yesterday's close, and we'll only buy on the open if the outside day was an up day. So what we're saying here is that yesterday has got to be an up day, i.e. the close is greater than the open, and if that's the case and today's open is greater than yesterday's close, we're going to go long. Conversely, if we're looking at a situation where yesterday the outside day was a down day, i.e. the close was lower than the open, we're only going to take a short trade, and we'll take that trade if today's open is lower than yesterday's close. In either case, we're going to exit our trade on today's close. Okay, well, here's the equity curve for that trade. Over this period, we've taken 31 trades, 18 which have been winners and 13 have been losers. That's not too bad. It's about a 3 to 2 or thereabouts win-loss ratio, and we've made 187 S&P points. This equity curve, it's okay, but it's not quite as compelling as the strategy that we looked at last. And let's compare these two strategies together. From the strategy that we only traded above the high and beneath the low of the outside day, it's by far the more attractive strategy, because not only is the win-loss ratio much higher, but look at the return on the average trade here. Whereas if we just buy above and below the close of the outside day, we make just over 2 S&P points. If we keep our powder dry and wait for the specific setup here and just buy above the high of the outside day or sell underneath the low of the outside day, we make quite a substantial difference to our strategy. Okay, that's the end of our discussion on two-bar patterns, specifically trading the S&P 500 cash with them. And I hope you've got something out of this. These patterns have been used for many, many years to trade the futures markets. The problem being is, of course, that, well, there's two problems. First of all, you have to be able to stay looking for the setup for the inside days and the outside days. They don't come along all that often, so it takes a bit of patience. And secondly, you have to actually take the trade when it's presented to you. If there's anything you'd like to know, if you'd like me to expand upon any points discussed in this presentation, please email me at kevin@tradersandinvestorsclub.co.uk, or come and visit the website www.tradersinvestorsclub.co.uk.